Hello, everyone. Good afternoon. I guess, yes, good afternoon and good evening, wherever you are. And thanks for joining us on our session. I think we still have a few people joining in, but in the interest of time, we would probably get started. So I'm Amrita Chatterjee, and we are Finarb. I also have Abhishek with me. So we work in data science, AI, and ML primarily, and we have worked across industries and various kinds of engagements. Fintech being an area of specialization. So as you can see from the topic that we have on screen, we're going to talk about deep risk. So this is basically the application of deep learning techniques for credit management. And what we would like to believe makes this unique is the use of, or the guiding principles of explainable AI that we bring into the picture. So I will get started, and we have a presentation, and probably we'll refer to the slides in between, just to kind of give you some context and share some data that may be of interest. So this is my homage to presentation 101. Start with a quote. But what's interesting is every time I look at this code, I'm kind of drawn to the fact that it's in the present tense. And much like credit risk itself, it's a continuous process, something that regulators and lending institutions are and constantly need to be on top of, because the regulators, whether it's the Basel guidelines, IFRS, or let's say the Federal Reserve, they set the policy, and they do it in the interest of protecting the consumer, preventing the economy from going into sudden shocks. And the lending institutions, obviously their interest is in trying to optimize the risk versus return. So essentially, they want to maximize the return on the risk adjusted return on their capitals, and obviously they want to optimize their capital requirements, which in turn would mean optimizing their risk weighted assets. So this is a known use case, and this is what credit risk and credit risk modeling revolves around. But what we are trying to talk about today, and probably trying to, where we would like your insights and what we have learned from our experiences dealing with clients and dealing with these similar sorts of use cases, is that the uniqueness in this approach is being able to retain the explainability of it without having to compromise on the accuracy. Now, credit risk is set by the industry standard. It is governed by regulations. So, if I were to just kind of give you the context here. So the frameworks are decided, and what the banks are trying to, what the banks look to do is they look to obviously minimize their losses. Now, typically they would run a decision model, which is for new applications. They would have a performance model where they would constantly monitor their existing borrowers. And banks would need to run the loss model. So let's say the loss given default, the exposure at default models, which is to cover their expected losses. And the other side is the unexpected loss. And all of these, again, coming under the guidelines of Basel. And then the other kind of model the other kind of losses that the banks need to forecast and prepare for are, catastrophic situations. So by which, stressing, shocking the economy, or therefore inducing the stress factors to see how models and essentially the credit environment would respond to that. To do this, typically the tools are again pretty standard: collateral valuations and collateral management. Now, this becomes very important for lending institutions because, if you remember about the subprime crisis, so what happened was initially, and on the face of it, all these seem like very attractive assets. But however, when one failed, all of them failed together. And it was like, an entire pack of dominoes going down. So which is what essentially lenders and regulators would want to avoid. So the idea is for the assets to not have a high degree of correlation. So which is where that optimization also becomes important for the lending institutions. And then again, we definitely have the scorecards, both at an applicant level, to see sort of to tune the parameters of risk versus the returns for each of the applicants, whether or not to give them a loan. Once they are given a loan, monitoring them constantly to see if they are at a risk of default in the future. And once all of this modeling is done, we fall back on the metrics of validation, and that is where the different metrics of how your risk versus return is that trade-off is optimized comes into the picture. The other aspect here becomes interpretability. Now, this is something we will touch upon probably in greater detail, but given that this is pretty much the standard framework, why does credit risk become so complex, and why is it that we constantly need to talk about it? And there is a room for improvement and innovation, if you will, of how basically we can get this right without having to compromise on accuracy, while still being able to answer to the regulators and still being able to give ourselves the leverage to get, let's say, develop a healthier portfolio of loans without compromising on the risk. So the typical challenge is obviously, insufficient credit history. And this is something that becomes more and more apparent as new kinds of customer segments enter into the market. In working with various microfinance institutions, we have seen that how they often struggle with credit history, because some of their borrowers or applicants are people who kind of, under the traditional sense, may not be considered as low risk. But they are in need of capital to start a small or medium scale business, for example. So this becomes a problem because essentially some of the data points that you have at the point of origination when a new applicant, is coming to you for loans, or the other set of data points is your performance data point. But for some of these new entrants, or even, the drive from the emerging markets, a lot of these people do not have, let's say, poor credit history, which would, in the traditional sense, maybe result in poorer credit scores or FICO scores. But in this, keeping in mind social inclusion, you need to devise a mechanism to bring them under the credit lending market or umbrella. In terms of limited data, and obviously, so this is the challenge of data, and some of these microfinance institutions also do not have access to a lot of data. So for example, institutional banks, banking on the large sets of customer base that they already have, they have a huge data set at their disposal. But a lot of new entrants do not have that kind of data at their disposal. Some of the data sometimes is also not usable, is sometimes not bias-free. So these are also factors to be considered to see whether the data that you have is something that you can actually use effectively. Then there is the problem of customization. So, in credit risk models, you obviously do some level of segmentation and clustering, but sometimes when newer kinds of entrants are coming into your lending umbrella, they may not traditionally fall under the low risk brackets like I was mentioning, but therefore there is a need to go deeper down, or be able to go to as much to as granular a level as possible, so that you can essentially look at each applicant individually to assess their credit worthiness and to assess the kind of trade-off it's healthy for you to aim for in terms of your risk versus your return. The next aspect, of course, is the interpretability. Now, so when we say interpretability, what happens is, if you run the traditional sort of the classical regression models, they tend to be interpretable. You can make sense of what's going on, but they suffer on accuracy. They are not as accurate. However, the deep learning models, they give you a better accuracy, but they are traditionally black box systems, so you do not really know what's going on behind that whole toolbox, and that is not desirable. And especially given today's regulatory framework, that is sometimes even detrimental to your credit risk model being acceptable, being accountable, and answerable to regulators, one, and also to your future requirements. And the one aspect that obviously, speaking today as we are, meeting today as we are on this virtual conference in the wake of COVID-19, is the impact that this has had. So this, for example, is one of those, economic shocks that I was alluding to earlier. So this is something that is unprecedented. No one was prepared for it. But now that we are in the middle of it, how do lending institutions respond to this? Because some of the data sets that were like maybe 6 months, 1 month old, have suddenly become obsolete. Some business models, because they are, their business models are not designed to be inherently adaptable to, let's say, a digital channel or an omni-channel experience, find themselves struggling, whereas maybe newer or leaner entrants who were probably not as, sort of bang for your buck earlier on, have suddenly been able to adapt and cash in on the scenario. So this is where, again, that aspect of being able to, being able to assess the long-term effects of the economy, of the, stressing the models with economic shocks become pertinent when you're devising your credit models. So given these are the challenges, and given that credit risk typically operates under a very set framework, what is it that we kind of are bringing to the table through deep risk? So through deep risk, what we are trying to say is, what the novelty here is that we have devised models which use deep learning techniques. So they are accurate. They are typically, you are able to lower the false negatives of your model, but they do not compromise on the explainability. They still retain the explainability and the interpretability within them. And I'll come to that as to, how we go about doing that, what the approach is behind that. The other thing also is that we look at various data sources. So we do not concentrate only on, let's say, the origination or applicant data or the performance data. Of course, we also include macroeconomic data, and we also include the market data. Now, by market data, what I mean is, let's say, data from the stock exchanges. In some cases, we see that, when very small retailers or like I was mentioning, let's say SMEs, when they are applying for a loan, in some cases, they may have some company profiles available. So let's say on social channels, publicly available company information. And some of this often end up giving you a lot of interesting insights as to how, let's say, in case of a B2B or a B2C, how, let's say, the customers or the consumers are responding to the brand, if it's an existing brand that already has a social presence, that we can access the reviews or the comments to sort of get a sense of the sentiment of customers towards that particular company or brand. The macroeconomic data, of course, we get from the agencies that are publicly available. Now, socioeconomic data, again, is interesting. So what happens is, when you devise your credit risk models, obviously there is some level of clustering that you already do. And as and when more applicants come in, the models go through a continuous learning process. Now, what happens is when you see newer segments or newer kinds of customers, you're able to enrich the models with those socioeconomic clusters so that it doesn't turn out that your model is kind of, let's say, biased against a particular, whether a gender or a locality, because it's even a regulation or a principle or a policy requirement that in some cases for example, you cannot use gender as as a variable factor in your modeling decisions. So that kind of addresses the whole idea of social inclusion within your model. And obviously, with the advent of open banking, the other interesting fact is that now lending institutions often have access to, along with the health data, they also have access to away data. So wherever possible, for example, in one of the use cases, we were able to access the customers' 360-degree aggregated account data through Yodlee, and that lends a lot of interesting insights. You get access to transactional data, which are high-frequency, real-time data, which enriches the model, especially the performance model where you're constantly monitoring your existing borrowers. So all of these data sources essentially end up enriching the model, end up making the models more accurate, more inclusive, and also kind of make it that much easier to scale and that much easier to, let's say, extend to near economic and market segments as well. If I were just, so what you see here is basically a diagram of the data flow. So all these data sets that I was mentioning, so essentially with all of this, what we end up doing is first of all, we design a decision model which the banks would use to essentially decide whether or not to give a new applicant a loan. And for this, we use the origination data that we have. We use the macroeconomic data that we, in terms of, let's say, the inflation rate, the unemployment rate, things like that. And then we have a performance level model, which is like I was mentioning, for the ongoing applicants, you constantly monitor and see whether they are likely to default. The other thing is the loss data. So basically, with the loss data, the macroeconomic data, and the existing applicant data, what we do is we design the models which is to assess the expected loss. So the loss given default model, and then the EAD model, which is the exposure at default. Okay, just one caveat here, and because we will go to a few screenshots shortly. The screenshot that you will see today, it's because obviously we cannot show you the exact client data. So the screenshots are from an open source Freddie Mac mortgage loan data. So obviously for that, we do not need to devise a model for EAD. It is a calculated field because it's essentially, fixed repayment loans. But let's say for lines of credit, etc., where we need to devise an exposure at default model as well. The other is the CCAR or the DFAST model. Now, this is obviously, as you know, this is against the Basel guidelines, and this is to shock the economy and test the effects of those stressed economic factors, and to see how our credit risk models would respond. So let's say how the probability of defaults across our customer base might change, or representative customers that represent the population. So how the credit risk models would be impacted from those stressed economic factors, the DFAST or the CCAR models. I mean, the CCAR is obviously something that bigger banks need to use essentially as part of policy. So with all of these, we are able to calculate, one, the expected loss, the second, the stress models for loss, and what all of this does in turn, which essentially is the end objective of the bank, is to be able to strike that right trade-off between risk and return. in order to in order to maintain the right level of regulatory capital and also their economic capital, which is why through which they can get healthier portfolios of loans, and they can also minimize their optimize their capital requirement, and in turn bring down their risk weighted averages. So now coming to the point of explainability. So I was mentioning the data flow, and with the data, so using all of this data and the modeling that I was just referring to, whether it's the decision level model or the performance level model. Now, in there, when we say that we are using deep learning techniques, what we are able to do is we are able to achieve higher metrics. And my colleague Abhishek will kind of take you through some greater detail of behind the hood of the modeling and the framework and some of the metrics that we are able to hit through these deep learning techniques. Before we go there, I just wanted to touch upon the explainability aspect of this. So what typically happens is, in terms of explainability, what happens is that, let's say you have a variable set and you have multiple variables. So how explainability is usually achieved is you would change, let's say, 1 unit of variable x1, and with that you will see the effect that it has on your dependent variable y, given that everything else, all the other variable remains the same. But that is not what usually happens. And I mean, realistically, that is something that never happens. So that is where we have, brought in our approach, where we use something called structural equation modeling. So by which we are able to treat this entire variable set and, tune or change the change parameters against along the entire variable set, and then see how your dependent variable, or in this case, your predicted variable, responds to that. So just to give you an example, so let's say for a bank, let's say your probability of default, you have decided on a cutoff for your probability of default. Now that is backed, or in the back end, what happens is you have said that, let's say for these sets of applicants or these sets of customer data set, I am going to operate within the bounds of a certain range of interest rate. So what we try to do through this interpretability or explainability is to say that if you were to change those interest rate within those boundaries, of course, how would your probability of default be impacted for a given customer? So we are able to achieve that localization, or let's say the effect of the changing variables at a local level or at an individual applicant level. The other level of intelligence that the models are also able to achieve is that they will tell you that if you were to allow the probability of default, let's say, to moderate along a certain range, then how far can you change your interest rate, and how does that affect the modeling outcome? Essentially, by modeling outcome, what we mean is that whether or not, let's say, the person is going to default or the applicant is going to default. And so we are able to generate high fidelity sample data sets. And what I mean by that is, so for example, if you were to consider a data set, let's say a particular borrower who has an income in the range of, let's say, 100,000 per annum. So I'm going to generate sample data sets to see if their income were to change to the tune of, let's say, 1.2 or 1.3. How are my other variables changing, and how is that impacting my my expected or my predicted outcome? And all of this is model agnostic. And why is this model agnostic? Because when we are doing this interpretability or the explainability, what we are interested with is that set of variable space of all my dependent or x variables and their outcome on the y variable. So it's imagine this like a partial derivative of x, which impacts the outcome on y, without the assumption that all my other x variables in that variable space remain the same. So we are going to go back, we are going to go to a few graphs and snapshots that we have captured for you, just to give a sense of, as a business user, let's say if you were to use the dashboards, or if you were to use the application, then as a business user, you have a certain set of parameters. Let's say a credit risk officer, they have a certain set of parameters which they would want to tune and moderate to see the effect. So we would show some of those screenshots from the feature importances and how tuning them can impact the model outcomes, or the impact on the predictions. The other thing, and which I was probably mentioning towards the start as well, the very important fact that models need to be bias free. And of course, this is where the value of adding in all those various sets of data and various sources of data come into the picture as well. But even with that, the one thing that that is true is that when you're designing a credit risk model, what you have with you in terms of training data is historical data of loan applicants. So when I say historical data of loan applicants, is these are people that you have already given loans to. So essentially, all your data set is of people who you have already given loans to. So you do not have essentially any reject applications in your historical data set. So what we try to do here is that now, because we also run performance models wherein we are monitoring all the existing borrowers constantly over a period of time, we are trying to see that, let's say for a particular borrower who is who is an existing borrower with the bank currently, if we see that some of their parameters have changed, and if you would reject an applicant because, let's say, they are because they may have a low income level, because let's say your variable or your features of importances are income, education, maybe age, credit score, what have you. So you would reject an application because they did not meet up to the cutoffs that you have set along these parameters or along these variable features. However, from your ongoing performance data, let's say you have an applicant who has whose feature values have changed over the course of time, which have made them currently, if they were to come and ask for an application, you would have rejected them. Now, so then this becomes a representative, let's say a representative applicant for one of our reject applicants, who had similar sets of features as this one. So through this, what we are able to do is we are then able to go back and label those reject set of applicants as to ones who may have defaulted versus ones who may not have defaulted had we given them an application. And then we use this data set and bring it back into our decision models to kind of enrich it with this infer these rejects back into the model. And through this, we are able to reject, we are able to, let's say, nullify the bias that would have otherwise cropped into the data itself, where our data would not have seen any reject applicants, when we are designing the models. So these are some of the differentiators that, that are ingrained into our modeling principles, our design principles. And I think probably we will now move a little bit into sort of the nitty-gritties and the technicalities of what exactly is going on, what are the algorithms we use, and what is some of the results and metrics we're able to achieve because of that. And my colleague Abhishek is going to take you through take you through the chops on that.
Sure. Hi, Amrita. Hi, Amrita.
Hi, Abhishek. Hi, Abhishek.
Okay. Hope I'm audible. So, thanks, Amrita. That was a wonderful explanation. So, right now, basically, we move on to like the modeling approach, and as you can see the flow chart here. So, I'll just walk through how we approach the modeling here. So, when a client comes in, we basically have a data ingestion going on from the client's data sources. Then we have the nitty-gritties of the data flow pipelines through it may be through different technologies, maybe something from like Azure Data Factory to Apache Beam, the open source market, etc. And then we have the feature engineering, feature extraction, diamond reduction, etc. built in. One point to touch upon here is, for example, dimension reduction is a very important aspect in credit risk. The simple reason being your PD model and LGD model, when you calculate the expected loss, you are multiplying basically the PD, the LGD, and the EAD. So when you are multiplying PD and LGD, they should be independent events. So when PD and LGD are independent events, we need to focus on dimension reduction because we have to devise it in such a way that the techniques like principal component analysis or component analysis are done so that the individual components of the variables have the minimum amount of correlation there. Ideally, they should be orthogonal or zero correlation, but have the minimum amount of correlation there. Once that is done, we obviously look at the plots and see the variable correlations, etc. And then, based on the amount of data that we have, we either go for the machine learning or deep learning approach or a rules based or flow data modeling. Why the differentiation is because, for example, in credit card loans or SME loans, we have enough data, to create the statistical models or the machine learning or deep learning models. However, for portfolios like ultra high net worth individuals or very like Fortune 5 clients, there are only 5 companies like that. So the number of clients you will have is very less. So what you do there is a qualitative sort of risk assessment, which is based on rules. So we create a rules engine for their default modeling. So based on the type and amount of data we have, we choose the model algorithm. Once the model algorithm is satisfactory, the performance is satisfactory, then we move on to deploying the API endpoints and all that. But apart from that, once that deployment is done, this is also connected to a reinforcement learning network where using techniques like multi-arm bandit, etc., we penalize the model for every wrong decision it takes and reward it for every right decision. And based on that, the model continuously improves on its own. The other important aspect here is transfer learning. So, for example, let's say a lending institution which was initially catering to SMEs suddenly have mid-sized companies coming into their portfolio. Then you can take the learning that you had from SMEs and adjust that to the mid-size market to a new portfolio while adjusting for the differences in that new portfolio. So that is in just the functional flow of the modeling. Now we will move on to basically the deep learning layer that we are using. So the deep learning network that we have devised for this particular problem has 4 parameters here. So not 4 parameters, or 4 layers here. One is the input layer, which ingests the data. After the ingestion layer, we have the event to vec layer. Now, as you saw that we are taking into account the performance data for the performance models, where it's a flow of information. So in a point in time model, we might have customer A who has a 12-month credit history versus customer B who might have 3-month credit history. So that might vary. So in traditional models where you have one row per customer, it is not possible to take into account this unless you aggregate the measure. And whenever you aggregate something, you are losing out on information. Uh, so in this way, in a deep learning model, you can take into account this flow information. So that flow information is taken into account in the event to wake layer. So event to wake layer something like uh, is something like, if I draw the analogy, uh, it is taken from the word to vec concept. So in a paragraph, a word is a context within that paragraph. So when you're using a word to vec model, that word is vectorized based on the context. The context being the paragraph where the word was in. Similarly, here also, event is the analogous to the word, which is a particular transaction. If it is you are taking open banking data, it can be a bank transaction. If you are taking the performance data, it can be a single loan repayment transaction, or whatever event is happening. It might be change in his FICO score, whatever it is. It is a word in the entire paragraph, the paragraph being the entire transaction history for that particular customer. So that is the event to wake layer. Next, we have the attention layer. Now, what the attention layer does in short is it basically removes the requirement of, so either you have an encoder decoder or you have the attention layer. What the encoder decoder does is the encoder encodes that flow information, models it, and the decoder outputs the whatever output you want. It decodes it into the output. But the problem with this is encoder decoder requires a fixed length of a fixed period. Like if I set it to 12, it will always look at the last 12 period history. But attention layer has the capability of crossing that, not having that barrier. It can easily do the it can easily work this out that customer A has a 12-month history while incorporating the fact that customer 3 has a 3-month history. And then maybe for customer A, it finds out that it just needs to look at 2 month, 2 period back in time to get to a proper estimation of, let's say, the probability of default. While for customer B, it needs to look back only for, let's say, 1 month. So that variable memory is built into that attention layer. And finally, we have the output layer. In output layer, we use the sigmoid transform to convert the predictions into a probability. And this sigmoid transform is actually quite intuitive. And this is the reason why most of the banks, or almost everywhere, logistic regression is a default standard for credit risk models. The reason being, if you think about logistic regression as a S-shaped curve, where the y-axis is the probability of default and x-axis is the income. Like common sense tells us that higher your income, if your income is towards like the right-hand tail of a distribution, or in this case in the x-axis towards the extreme right of the x-axis, then what will happen is you are to the upper top flat area of the S-shaped curve. What it means is even with small changes in your income, it is unlikely that your probability of default will change. Similarly, if your income is extremely low, there also with small changes in your income, it is unlikely that your probability of default will change. It will still remain low. But if you are in the middle group, then the probability of default will change with small changes in your income, because that is the steep part, and it will change. So ideally, these are our risky customers, because the risk comes from the variance. It is this part of the curve where there is the most variance. So that is the reason why we basically use the sigmoid transformation, because it has a theoretical or logical application to the credit risk modeling domain. Now we'll move on to some of the metrics that we have achieved through our models. If you see here, so first of all, we have the decision model. So we are using Gini for the classification models, which is a basic standard. Now, for the decision models, as you can see, in logistic regression, even if you look at the right hand side column, with logistic regression and including all the data, you can get to a level of, let's say, 0.71, while using neural nets, which is the multi-layer perceptron, you go up to 0.76. It's an improvement, but still not that much. But if you look at the performance models, while the normal logistic regression goes up to a Gini of 0 on the same data set, goes up to a Gini of 0.58, the deep learning and ensemble model based on deep learning and XG boosting goes up to 0.93 without overfitting the model. So every metric you see here is on the validation data set. So that's how it can raise the bar. And similarly for LGD model, when we're looking at the R squared, if we look at the deep learning and light gradient boosting model, that takes it again up to in the ranges of 0.93. If I'm not wrong, it was something like 0.928 or something like that. It's rounded off. But for linear regression, it is only like 0.63. Even with light gradient boosting, which in normal classical terms performs the best, it goes up to 0.81. So that is how the deep learning models perform better. Now, in the deep learning models, as my colleague Amrita was saying earlier regarding the explainability of the models, um, in these deep learning models, our explainability models are basically model agnostic, which means that we only need the predictions, and the x variables to understand the relation between the predictions and the x variables. We do not need to go into the inner workings of the model, which is extremely difficult to do in a deep learning model. Uh, so we just need the predictions and the x variables to understand how the variables are interrelated and how that is affecting the probability of default. So with that, we will move on to some of the screenshots that we have for our dashboards. So there is a basic dashboard which tells you as to how, like, the distribution or monthly distribution of non-performing assets, then the ratings and the default rates, geographical distributions of PD across the different services, then the distribution of across months, and the risk-weighted capital requirements, risk-weighted assets across the different models. Next, we'll come to the, so this one is basically a view of your entire portfolio, which is given to you in the form of, so every column has a distribution associated with it. So based on that, so you'll find all the PD, LGD, EAD scores for every customer here. And based on that, if you want to delve into any particular customer, you will have to apply the filters on the right-hand side, and you can select those customers. Now, once you select a customer, you can go to the user-specific dashboard, which is this one. So here you can see the probability of default as a point-in-time measure, the LGD as a downturn. And so, for example, this dashboard was made for compliance with both the Basel and the IFRS 9 requirements as in US. So it has a downturn and the average measure for the LGD. It has a recovery rate. It will also give you, if you look at the lower row, it will also give you the point-in-time current PD measure, which is 17%, for example, here. And the other part is it will also give you the optimized PD measure. What is the optimized PD measure? It is saying that for an applicant, if you change the terms of the loan, which can be the interest rate, loan term, the balance, the total loan amount, etc., or for an existing customer, it basically can be the refinancing or restructuring his current deal. You can basically bring down the PD to 8%. On which variables are you optimizing? That is shown in the lower part of the dashboard. So in the lower dashboard, where you can see the PD, LGD, and EAD driver importances, you will see there are markings of red and green there. So what red means are that those variables are not touchable. So they are things beyond your control. For example, Fed funds, unemployment rate, those things are not in your control. But things like, the green ones, which are loan term or loan to value or interest rate, these are some things, some items where you can modify the data. You can change it within certain bounds of your business rules and requirements. And by changing that, you can go up to a minimum of 8% PD. So that's what we are trying to show here. We are also giving the credit score. From history, we have like how many past loans this person had, and we are also attaching a 91% score confidence. What this means is when we are highly confident about, we also attach the degree of confidence. What that means is roughly 10% data in the middle, which gets a low confidence score, we are not able to pass a judgment on that one, because what the model is saying is that whatever our prediction is, we do not have that much confidence, or we are not that much certain about this sort of customer, probably because that was an underrepresented sample. It might come from an underrepresented sample. So hence the degree of confidence might be a low. Now, at the top here, you can find the bullish, normal, bearish, and stressed. So these are states of the economy. So using DSG models like Smith's Waters, etc., we are modeling the economy, we are applying shocks to it, and based on those distributions, we basically create 4 situations of the economy: bullish, normal, then we have a stressed economy, and we also have a bearish sort of economy, which is not that much stressed, but it's like falling. So once you select any of these tabs, the predictions and the importances, everything will change here. And you will get the picture of how that particular customer will behave in a certain economy. And this kind of covers our need to do this in this sort of an economic situation. So this is what we are getting from the local interpretation of models. So model interpretability has 2 aspects. Number 1, how are you explaining the model as a whole for the entire data set? And number 2 is how are we explaining the models for a particular customer or a particular client. Now, the other dashboard that we have to see, this one is for the global interpretability of the models, which is just one second. Yeah, here. So here we are just showing how the variables are reacting. So obviously there are a lot of customers, so the network diagram is pretty complex. But what you can see here is when we are selecting on the right-hand side, first of all, on the extreme right-hand side, you can see the importances of the respective variables. Now, in the chart itself, when you see that you select a particular FICO score, you see that most of these customers are getting a particular interest rate bucket. Among those interest rate buckets, ultimately you will see them going to different sellers and services, but you will find that almost 95% of them are ending up in the similar PD bucket, which is the second largest PD bucket. So this basically shows you that interest rate is a very important driver. Interest rate and FICO are a very important driver for the PD model, at least in the top buckets. With that, we'll move on to a summary slide, which I'll hand over to Amrita to walk you through this.
Thanks, Abhishek. So, just to, in the interest of I will probably quickly summarize. So what you see here is essentially these are the tenets that we use in our approach to credit risk modeling. So first is data. Look at the right sources of data. Data needs to be extensive, but it also needs to be usable and effective. And again, something that we have found to be immensely useful, especially when working with like I was mentioning, microfinance institutions, where they need to address also, the factors of social inclusion, and bringing in new kinds of customer segments into the lending portfolios. Second is the modeling frameworks of the algorithms themselves, like Abhishek was just explaining, deep learning techniques that lets you achieve better accuracy, lets you get better metrics. And essentially, by being able to do that, what we are able to do is, for the lending institutions, they can maximize their risk adjusted returns on capitals, and which in turn means optimizing their capital requirements. So this essentially is the basic guiding principle of any lending institution, without having to compromise either on accuracy, or and therefore either on return or the risk. The And these are, again, like I was mentioning, these are again following the Basel guidelines or the IFRS, and in some cases where they may be in conflict, the law of the land obviously takes precedence. And the fourth, and we like to believe probably one of the most interesting or important factors, is the explainability, which is where, like Abhishek just was showing you some of the graphs as well, because essentially we understand that these models are going to be used by business users. And our submission is that, we do not expect all lending institutions to have data scientists as credit risk officers. So essentially, the idea is to have an application or a solution that business users can use and make sense of, and they can see how changing model parameters or how changing input variables can impact their lending decisions. And not just in point in time, but also through a given period of time, in terms of testing the long-term effects of the economy, in terms of also bringing in the other factors of market and socioeconomic data. And so we would end with that. We would leave you with those thoughts, and if you have any questions, we are happy to answer them now, and we are obviously available on the platform, I guess, for the next 2.5 hours that this fantastic event is still running. And I'm just going to leave you with this slide here, and you will also see the link pasted on the chat screen here. Is that what we were talking to you about today is sort of the amalgamation of our experiences in working with clients in various across various lending institutions of various scale and size and markets. What we are going to do as a follow-up to this is, they are hands-on clinics or workshops, if you will, and we are going to run them on multiple dates over the next few weeks, and we hope to make these, tuned and customized for the audiences. So we would be, we would be very happy if you would come and join us, if you would sign up for any. Let us know what you would like to see, any particular use case or any particular requirement or aspect that you would want to cover. And that is where we can give you obviously a better sense of the application and take you through the ropes of how exactly a business user would see it, how they would interact with the system, what are the data sources that are being pulled, what are the limitations, what are the, where we can use something, where we cannot, if we can use something, how we need to make sure that the data preparation that goes on in the background before the data can be used into modeling. And then once your model is set up, how you can make the models answer to you, and essentially, answer to all the regulatory and internal requirements and, policy requirements and capital requirements that you have. So thank you everyone for joining, and we hope to connect with you through the platform and through the other social channels. And we do look forward to seeing you in one of our clinics. We would be sending out invites as well shortly for you to set up, specific times. And thank you once again. And again, great, fantastic opportunity. And thank you to all the organizers as well for making this happen, where we are, it really is a small and connected world through all these virtual networks. So thank you and have a good rest of the day. Bye-bye.